Hi everyone, good morning. Uh, Today we will be starting question number 11 onwards of valuation series, the advanced questions. Previously we have covered question number 1 to 10, and these questions are actually taking a lot of time, and these are actually required to think how these concepts are applied. So uh, let's get started with the series now. So question number 11 uh, is about how far back and forward do we usually go for public company comparables and precedent transaction multiples. So, public company comparables, we have discussed these terms, and precedent transaction multiples. We've discussed these terms previously in detail. So, here the, we are working with valuation multiples. So, whether for public company or precedent transaction, there is typically look back and forward, look look forward horizon that makes sense, and knowing the rationale behind it is that for public companies, you typically start with a baseline of the trailing 12-month as you present state snapshots. And in terms of looking backward, it's common to go back more than last 12 months. So often 2 to 5 years of historical multiples, because this gives you visibility into how the business and markets have evolved. So 2 to 5 years of data is the historical data is it actually gives you visibility and of about the market, how markets are evolved, and how business is getting evolved. And for looking forward, in this case, you often use 1 to 2 years of looking forward estimates. So you forecast for 1 to 2 years. For example, next year or after next year's earnings by EBITDA ratios, you are trying to forecast those numbers. And because public companies generally have analyst forecasts and market expectations are available. So this means that for public companies, and there are a lot of analysts which are covering those companies. So you can make a judgment from their analysis and their research and about your company, and market expectations are also available. So, and the advantage here is that the public companies are transparent and forecastable. So you can reasonably justify forward multiples when peers are similar in growth, margins, and risk profile. So if I ask you why you have forecasted, or why are you looking forward with this rate, or why are you considering this much growth for the company? So in your defense, you can say that because of the peers are showing similar growth and margins and risk profile, and the expectations of business and markets are available. So you forecast 1 or 2 years in the future only, not more than that. In every quarter, you then update your forecast. So I hope this was clear about public company comparables, that how far and backward do we look, and why we look only for 2 to 5 years of data, because every 2 to 5 years market resets itself. So if you know about uh, the demand and supply, so every now and then, if you have a business model and that's profitable, so other companies are going to enter that sphere, and they will start making those goods only to if there is an increase in demand. So here market, everything will be applied, all those concepts which you have read in economics, Michael Porter's five forces, and markets, how demand and supply curves. There are different types of markets: oligopoly, monopoly, perfect competition, and those concepts, those will be applied here. That's why we look only for 2 to 5 years of data, and forward looking. We only forecast 1 or 2 years in the future, given that other analysts are also saying the same thing. And when you are publicly forecasting a company, then it's very important for you to track the news, what's happening in the economy, political wise and geography wise also, how geopolitically things are going. So these things, you actually, if you are a public company analyst or you are an equity research analyst, you need to work on all these things also. It's not just that it's not a desk job, or it's not a 9 to 5 job for like 10 for 8 hours or 9 hours you have worked and that's it. No, it's actually the professional. When you are working as a professional, it's beyond 9 hours. And okay, let's not digress from the topic. Let's talk about precedent transaction multiples now. So if you think again, uh, uh, for 12 months of target deals, uh, historical window you might consider it for 2 to 5 years when you're looking at transaction multiples, precedent multiples. So, depending on the industry and deal frequency to build a relevant sample of transaction multiple, here also you will need to have 2 to 5 years of data backward looking. So for past historical 2 to 5 years data. However, looking forward beyond the deal date, you will typically there will you will not go much more than 1 year here, because if at all, because the data for what's the target did after the deal is less reliable or less available of it, and you use the target metric at signing or closing rather than deep forward estimates. In short, also think about it that less forward horizon for transactions than for public comms, because the data is scarce for precedent transactions and there is greater uncertainty. And why this difference occurs is because public company comparables provide regular disclosures and analysts cover those companies and for forecast their financials, so you can reasonably project in future. And but in precedent transactions, transaction dates involve a complete sales of this company only, which may be private or lightly covered, and the future performance of the target is typically opaque because it's a private company now, and making longer forward projections is less actionable actually. So that doesn't make sense, because once this is a public company, everyone is covering that and there will be a consensus data, but this is actually a private company now. Even if you have uh, witnessed what happened with Twitter. So after Elon Musk actually acquired Twitter, Twitter went public or private. Earlier it was public. So on SEC you can see, Securities and Exchange Commission, that Twitter used to publish their data, but after the acquisition, Twitter actually has stopped publishing their data. So how will you value a Twitter, or how will you value X? And also when looking further back or in the historical or in the forecasted data, your risk include outdated or highly speculative data. So if you have highly speculative data, then that will increase your risk, or outdated data that will actually increase your risk. And using a time window that balances recency or relevancy and sufficiency is a part of good valuation practice. So here also in the reasoning, there is written that start with trading 12-month back period for both public and comparables. Public company and the precedent transaction. For public company, typically look backward more than 1 year, 2 to 5 years, and you can look forward for 1 to 2 years. But for precedent, you commonly look back to recent past, 2 to 5 years, but it is usually to project multiples using forward beyond 1 year, because deal dates and future forecasters are limited. I hope this was clear. Um, yes, it is a little confusing, and valuation questions in advance. Advanced valuation questions are only if someone at senior level is interviewing you, uh, they might ask you these questions. But or if you are appearing for an advanced position, they might ask you these types of questions, which involve a lot of thinking and rigorous understanding of the markets. And so let's move to question number 12 now. So question number 12 is actually a tricky question. So if I have one company with 40% of EBITDA margin trading at 8 times of EBITDA and another company with 10% EBITDA margin trading at 16 times of EBITDA. So what's the problem with comparing these two valuations directly? EBITDA margin means EBITDA divided by revenue. So if for $1 of revenue, you are having 40% of EBITDA means 40 cents of EBITDA. And here for $1 of revenue, your EBITDA is 10 cents, 10% of revenue. So margin means you are dividing it by revenue. EBITDA, wheresoever you see that it's margin, it's saying margin. EBITDA margin is divided by revenue. So the issue lies in the fact that the two companies have dramatically different margin profiles. And since EBITDA multiples inherently reflect not just earnings, but also efficiency, risk, growth, sustainability, and comparing them purely on the multiples without adjusting for margins is actually misleading. So, margin actually implies that we have discussed that 40% means on $1 of revenue, 4 cents, 4 cents, no, $1 of revenue, 40 cents, and here $1 of revenue, they are making 10 cents. And this means that high margin businesses is far efficient at converting sales into operating profits. And it also typically translates into stronger cash flows and lower underlying risk here when the EBITDA margin is high. And according to valuation theories also, companies with higher margins tend to deserve higher multiples because they generate more surplus per unit of EBITDA. But here the valuation is low. And why there is a difference, why the multiple difference might be justified, non-anomalous, because 10% margin company trades at 16%, and which at first glance seems expensive compared to the one at 8 times of EBITDA. But if it has weaker margins, high cost structure, more investment, reinvestment needed, or risk of margin expense, margin compression, so investor may require higher multiple here to compensate for operational risk and expected growth. And meanwhile, for the 40% of company, uh, company might trade at only 8 times of its earnings, and it already have strong, predictable, higher earning quality. So less upside is there, and there the risk is low. That's why it has less. Its valuation is less. But if here the risk is high, and that's why it's driving its valuation. So its margin is trading at 16 times of EBITDA. That's why, because there is risk is high and their risk is low, and that's why the margin is, so the trading it's trading at its 8 times of X EBITDA, and it's trading at its 16 times of EBITDA. And why direct comparison is risky if you are directly comparing these things and without looking into those factors which are affecting these things. Even though 40% EBITDA if everyone is willing to buy this high growth company, so this should have been high. So everyone would have paid more for this. But here they are paying less for this. And here they are paying more for this because the risk involved is high. So if you treat 8x and 16x as purely company, so you are ignoring the underlying margin difference that drive the fundamental value per sales of dollars. And in fact, you might misinterpret the 8x as cheap, and when in reality the company may deserve a premium multiple, giving its margin. So you might interpret the 16x is too rich, when in fact the business might need the premium to compensate for weaker high margin structure. And also, What you should do instead here in this kind of problem is first you recognize that the margin is a key dimension here. When you compare enterprise value to EBITDA, multiples, profitability, cost structure, and reinvestment needs risk. Uh, and therefore, when doing peer comparison or screening in these kind of questions, you adjust your peer set so that you compare companies with similar margin profiles and avoid trying to mechanically normalize the multiple across margins. In your own valuation here, if you're doing a valuation, you might incorporate margin differential into your assumption of growth, reinvestment, or exit multiples, but you do it via assumptions, not via blunt multiples or blunt multiple adjustments. So if just to uh, just a quick summed up summarize just a quick explanation for this would be that company A's margin are 40% and trades at 8x. So there is strong margin, an efficient business, and less risk, and possibly lower growth also. So investors are comfortable with only 8x because of the lower growth. But here, if you look at company B, the margins are weaker. I understand that. So the efficiency is low. So because there is higher risk and need for margin improvement, hence higher multiple to compensate for the risk, or acknowledges greater growth potential in the future. So that's why 16 times of EBITDA they are trading at. And you cannot conclude simply that company B is overvalued or company A is undervalued just based on multiples. You might include margins and other structural differences also. You need to look at that. The- Like I told you previously also, so there is always a gray area. No, it's not right or wrong. So this is not cheap and this is not pricey. This is not cheap and this is not pricey. So the underlying story is that there is future potential. That's why it's pricey, and there is less risk. So less future potential. That's why it's cheap now. So let's move to question number 13. Okay, so question number 13 is about walk me through how we might value an oil and gas company and how it's different from a standard company. Okay, so this is actually a sector-based question, oil and gas. And I think next question is about REITs. Okay. So if you are, we will do a we'll talk about sectors and industries in our, I mean, give me some time, I will make a different series for that. That's important. And other than questions, knowledge of sectors is also important. So let's discuss the question first. So if you think about this, so what we can start with is commonalities and key differentiators among companies. So we will look at standard companies similar to standard companies when we are uh, valuing an oil and gas company. And you can do a traditional business valuation, like you compare company comparables, so precedent transaction and DCF models. And the logic is that forecast the business's future cash flows, assess what multiples the market pays, and discount it back and calculate the value. So basically, what makes oil and gas different is the underlying business. The underlying business is actually commodities and reserves rather than purely recurring operational cash flows. So product volume, reserve life, commodity prices, exploration, success, those matters. And many upstream companies may have finite resource life. Therefore, the asset base is less in going forever and more how long you can produce. And revenue and profitability are highly exposed to commodities price volatility and less predictable than many standard businesses. Uh, As of now, on 30th of October to 2025, if you are following news, so there is a war going on between Ukraine and Russia, and US is actually supporting Ukraine and putting sanctions on companies, Russian origin companies, 100% sanction. They have put US has put two a sanction on two companies, and this is actually impacting China, India, and other countries who were actually buying oil from Russia. So think about it from this perspective. If there is a oil, this is actually going to do an oil scarcity. So oil scarcity is there is an oil scarcity, then this is going to drive oil prices. Not from political point of view, but from an economic point of view. If there is a scarcity of oil, this is going to uh, drive oil prices up. But does the oil and gas company gets any profit? And which oil companies do get the profit? But understand this thing. The rate of dollar, the or rate of dollar, the rate of oil is actually decided in dollars. So this means if oil and gas prices goes up, US can still buy because US controls the dollar. But for other countries, it will be costlier. Being an research analyst, if you're tracking oil and gas companies, you should know all these things. The geopolitical aspect also. So that's what we are talking about. So the commodity prices are going to uh, impact the company, and the risk factors are actually complex here. Geological risk are there, regulatory risk are there. Like I told you, just I told you that sanctions are there. Depletion risk, commodity cycles, and there is a lot of hedging also done. So what if, so oil futures, oil options are there always. So specialized metrics like reserves, production rates, reserve replacement ratios, depletion curves, operating net backs. These do not show up in standard businesses. So that's why oil and gas is different. And revenue and profitability are highly exposed to commodity price volatility and less predictable than many standard businesses. And uh, if oil and gas prices drive up, it is actually linked with the inflation also. So if you're producing at one place and you are supplying it to some different state or some different country, though, so the you will be needing more gas now, or the gas, the travel expenses actually increase, and this will drive the costing also, the cost of the product also. To think a little rational and logical, think with a little rationale and logic. If you're screening an if you're talking about a screening in multiples like comparables and comparable and transaction analysis, so screening criteria might include daily production of oil. Uh, so there are reserves, proven reserves, probable and possible reserves. Those are P1, P2, and P3. There are three categories of reserves. We will discuss about them later on. But as of now, you just need to understand that proven reserves are those where we are going to get oil. So there is a I mean, with every reserve, there is a different probability. There is a different percentage of probability and the purity and everything. There's a lot of things which we cannot discuss in this video, but that will be a detail, and we will be digressing from what we are discussing right now. So just understand that. So there is a reserve replacement ratio. So we actually have to replace the reserve at some point of time. Finding and development cost per barrel equivalent. So and operating netbacks. This means the revenue minus operating cost per barrel. There are geography, asset quality, and cost structures also. And multiples, you might get enterprise value to barrel of equivalent oil. Enterprise value to BOE. So it's dollar per barrel of oil equivalent, BOE, barrel per equivalent of oil. And enterprise value by following production, which is enterprise value per barrel equivalent of oil per day. So that's one ratio. And enterprise value to EBITDA X. So here we have previously discussed also EBITDA X about EBITDA X, where X means exploration in oil and gas, and we discussed about adjusted funds from operations in REITs, if you remember, in the what were the multiples used. So EBITDA X, it actually includes the exploration expense because exploration expense is a huge expense for a company. So that is the non-adjust non it's a non-cash and exploration cost. And metrics like are gauge of to gauge the life of reserves. uh, R by P, and why it matters. R by P, proven reserve, last year's production. These kind of matrices we also use. And here it's EBITDA X. So standard companies can often trade on more stable metrics. But for oil and gas firms, the size, quality, and the life of reserve matters hugely. And you are essentially buying the oil and gas in the ground and the infrastructure to extract it. So multiples might reflect that. When we are doing intrinsic value or DCF, so intrinsic value, we so when we are using for DCF, so we will forecast production volumes year by year and forecast commodity prices, and we'll subtract operating cost, maintenance capex, and decommissioning cost also, which will be included in oil and gas reserves. Forecasting exploration and development capital expenditure and computing free cash flows discounted at a this will discount them at a appropriate weighted average cost of capital. And then we will talk about the terminal value, and which is a tricky part in product if because production declines. The terminal value uh, can it's very tricky when you are doing a DCF for an oil and gas company because production actually declines with time. So you cannot say that a company will be growing at this constant rate throughout, or the oil well will be growing at a constant rate throughout. And when if there is if we use a net asset value to reserve based model, so in oil and gas we use a NAV to reserve based model. So what we do is we identify the reserves and the possibility about the other reserves. So proven, possible, and probable reserve, we will identify those and we will forecast how many barrels will be produced each year until depletion. So net asset value. And we will assign realistic commodity prices as price assumptions across the production period. And we will deduct those expected operating costs and future development capex, taxes, royalties, decommissioning, and all those costs involved. We will discount then the net cash flows to present value. And when we add those values, we will get the value of the asset, the net asset value. That does make more sense. And the key difference between a stand and net asset value and DCF is that net asset values assume finite life of reserve and often does not assume perpetual growth beyond the beyond reserves life. It also assumes no major new reserves addition, uh, and it often does not. It often does at a asset or field level. So You actually need to visit those oil wells and those. And the biggest driver is the commodity price used for the reserves and the decline development curve. So small changes in the price or reserve estimate drastically alter the net asset value. And so net asset value we have talked about here uh, in oil and gas. So oil and gas companies are actually valued in a different way, and you might not have seen net asset values. And finding oil and gas experts, industry experts, are very difficult because their work is way too different. Just like banking is different, oil and gas is way too different. So banking and oil and gas and REITs, REIT, every industry is valued differently, and every industry has different standards which we need to follow. So when do we use it? If you think about it, uh, if a company is upstream and heavily dependent on the reserve base, so there are three types of companies also. So upstream, downstream, and midstream. So upstream are heavily dependent on the reserve base, so exploration and production focus. So net asset value is very relevant. If a company is more diversified, so integrated oil and gas refining midstream with ongoing operations and growth potential, so standard DCF or hybrid may be appropriate. And often analysts will present both a DCF and for an ongoing business and net asset value for the reserve base when weight then they will reconcile or weight those uh, as per the reserve base. So just to sum it up, to value an oil and gas company, you blend standard valuation techniques, multiples and DCF with industry specific inputs like production volumes, reserve life, commodity prices, cost structures, depletion of asset. Yes, it's an important part. And you screen using metric like proven reserve, production rate, R slash P, which is new, proven reserve by last year's production, EBITDA X we have talked about, and you build a net asset value model to adapt a DCF to reflect the declining production and no perpetual growth. And you overlay additional risk factors unique to the petroleum sector, like commodity cycles, geology, royalty regimes, environmental obligations also. Yes, environmental obligations are also there. And the end result of the valuation is that the end result of the valuation reflects both companies' ongoing operations and the value of the underlying oil and gas in the ground and asset base, and not a generic business forecast with steady growth assumptions. So oil and gas, try to Google a little about it. Whatsoever I knew, whatsoever uh, is available to me, I actually need to. I can do that. I can talk a lot about it. So then we will be falling behind in answering these questions and doing the series. So the whole purpose of the series will be lost if we talk in detail about it. Actually do have a presentation also, which I'll try to make it as soon as possible. So I will try to cover first oil and gas, then banking, then I will try to cover REITs, and then I will do the telecom, media, and technology sector. So these four will be done within a month. I will try to make a presentation about these. This question number 13, I will bring you back to question number 13. Then we will discuss it one more time, and we will discuss. Uh, First, we will do these industry sessions, and after that, we will do a valuation. So after completion of the industry sessions, we will do the valuations of every, not every, but one or few companies from every sector. One or two will be not enough. A few companies from every sector we will do a valuation about. So let's move to question number 14, which is the last question of this series, the advanced series. And advanced series has actually taken a lot of time of ours. And but I think that it was necessary to understand these uh, questions. These are advanced questions, not basic questions. Uh, but still, I think there is a scope that we could have explained them more with better explanation. So here in this question, they are asking about a REITs company, real estate investment trust, and how it differs from normal company. Hmm. So if you know, REITs is a real estate investment company. A real estate investment trust is actually a company which actually gives off 90% of it actually distributes 90% of its earnings to its shareholders. So this is one major criteria for a company to be REITs. Because so the key metric here is that REIT operates by owning and managing real estate rather than just selling products or delivering services. And the key metric we rely on I mean the key metric we rely on differ somewhat from a standard companies. Like the key metrics are fund from operations, AFFOs, adjusted sales from funds of operations, net operating income. Net operating income is also a metric. Capitalization rate. Capitalization rate. Uh, we talk about net asset value also. Net asset value. Just like we talked about this in um, oil and gas and dividend yield payout ratio. So one more metric which we rely on here is dividend yield payout ratio, AFFO to FFO. So fund from operation starts with net income, but we adjust uh, for real estate specific accounting distortions. So we add back depreciation and amortization, which in real estate often does not reflect economic value decline in some ways as manufacturing machinery. So if you think about it, so all the accounting concepts were built for manufacturing companies, not for other companies, other industries, other sectors. Depreciation, even though depreciation is a part in real estate, but this does not reflect the economic value decline of the building. Maybe the building's price are getting appreciated. And to calculate funds from operations, we add back depreciation amortization and we subtract gains on property sales. So if we sell the building, so we can adjust for the appreciation in the price and we will record it once we will sell it. If you think about adjusted funds from operations, so it goes a step further by stripping out recurring maintenance also, capital expenditure, tenant improvement, straight line rents. So it gives a cleaner view of funds from operations, adjusted fund from operations. Net operating income. So at a property level, this is actually gross property income, and we subtract the operating expenses and taxes. So this actually feeds into real estate asset valuation. Real estate asset valuation, net asset value is actually um, the the fundamental base of a real estate valuation, net asset value. When we talk about the uh, capitalization rate, cap rate, if we talk about cap rate, so this is used to convert net operating income into value. So net operating income, if we divide it by capital rate, this will give us uh, the value. So if it's stable or familiar in real estate market. When we talk about net, asset value, NAV, net asset value, 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 net Okay, so NOI actually feeds into real estate valuation. Net asset value is the market value of REITs, the real estate asset, and we subtract liabilities and divide it by the number of shares outstanding. So net asset value, and it actually provides an asset value floor for valuation. And then there is dividend yield to payout ratio, which is relative to AFFO or FFO. So because REITs are income vehicles, the sustainability of this distribution matters. Uh, so how it's different from a normal company. So if we talk about depreciation distortion, so if we in a typical company, depreciation of machines and equipment is matched to economic usefulness. In REITs, depreciation of building is more accounting driven and may not reflect market value decline because net income is less meaningful and you shift to AFFO and FFO here, AFFO and FFO. And how it's different from a normal company. Assets are the businesses, and for most companies, value comes from future free cash flow growing the business. And for REITs, the large portion of value lies in the real estate portfolio itself, land and building. So the asset base matter heavily, not just growth of operations. So asset base matters, but not the growth of operations. If you talk about the leverage in real estate market sensitivity, the REITs typically carry significant debt on real estate and are exposed to changes in interest rate, capital rate, property market cycles, and occupancy and lease risk. So these are less dominant for a typical company, but far more central here in the REITs. And high dividend to distribution requirement is also in the REITs. So many REITs are required by law to distribute most of their taxable income, limiting reinvestment and making dividend sustainability a key metric. And typically, companies may retain earnings for growth, but like I told you, 90% of their income they actually distribute among their uh, shareholders. And also valuation focused timing is there. If in traditional companies, you might emphasize on the price to earnings multiples, free cash flow growth, margin expansion. But in REITs, you focus on price to FFO and price to AFFO, net asset value per share, capital rates, occupancy, lease rollover, property specific drivers. Uh, think about it, replacement cost and property specific variables also. So from the perspective of replacement cost and property specific variables, these matters. I mean, these matter far more for REITs. For manufacturing business, you might consider cost to replace the manufacturing line, but in real estate, you consider cost to build, land availability, zoning, redevelopment, and extra. So, so real estate investment trust and a normal company, they are way too different. These are north and the south poles apart. In simple terms, so I would start by recognizing that a REIT is fundamentally different from classic operation or operating company because its value lies in larger extent in the real estate portfolio. So I would therefore focus on two sets of metrics. So one metric which measures the cash generation specific to REITs like AFFO and FFO, and the second measure of assets value, so an NAV per share. Two types of metrics, FFO and AFFO, and net asset value. So these should be the two kinds of metrics. So first, I would compute the REITs FFO. So FFO is computed by net income plus depreciation plus amortization, and we subtract the gain on the property sale. We will realize, so this is the formula for FFO, but we will realize the gain on the property sale also. We'll subtract the gain on the property sale. So this gives us a cleaner view of recurring cash flow. And then we will adjust further to get AFFO, we will be deducting recurring maintenance capex, tenant improvement expenditure, etc., and which tells us the sustainable cash flow available for distribution. And for the second metric which we were discussing, the net asset value. So we will focus the net operating income for the property portfolio, and we will apply appropriate capital rates to convert net operating income into market value of the properties, and we will add any non-core assets like cash and receivables. We will subtract debt and liabilities, and we will divide by the number of shares to get an NAV, net asset value. And think about it. So to cross check, um, we need market multiples. For example, price to FFO and price to AFFO, and we will compare to other REITs in the same property sector and see whether REITs is trading at a premium or discount to its peer. So comparison is necessary. And lastly, reconcile. We can do reconciliation if the current price is far below net asset value per share. That might suggest opportunity. And if it's trading at a high price to FFO multiple relative to peer, that might reflect high growth expectation or relevant risk also, or elevated risk. And importantly, if we do a sensitivity analysis, varying cap rate, occupancy, and maintenance capital expenditure and interest rate, because because in real estate valuation is sensitive to those assumptions. Capital rate, occupancy, maintenance capital expenditure, and interest rates. So we can do a sensitivity analysis. And in contrast, if you think about it, the normal company valuation don't rely primarily on ne net income or price to earnings multiple. So you place far more weight on the underlying asset value. When you're doing a REITs company, when you're doing a REITs valuation, and underlying asset value, capital rate, occupancy profile, property specific risk. So those are actually the drivers for the sensitivity analysis also. So REITs valuation is more asset intensive, and you must carefully model both property portfolio and cash flow dynamics, which are unique to REITs. So that's been said. Uh, I hope you have the basic understanding of REITs and oil and gas now. Uh, just stay tuned to the channel. I will make sure that all of you be clear about the concepts of all the sectors and industry, conceptual clarity. So valuation questions, advanced level questions, these are actually time consuming questions, and they took a lot of time of ours. So next, we will be starting with discounted cash flow question and answers. There are 32 questions, and I will try to uh, make detail. I will try not to skip anything because one thing is connected to another. So if we are not covering it in the valuation part, or other we have not covered it previously, maybe that will be the foundation, or the foundation that will create the foundation for the future question and answers. And thank you for attending this series. Uh, for any questions, kindly post in the comment section. I will be happy to answer. And thank you. All the best.